My name is Aman and I'm a chartered professional accountant practicing in the Metro Vancouver region of British Columbia, Canada. We all know that inflation and rising interest rates are dinging balance sheets and may even cause financial problems, including but not limited to CRA tax debt issues, especially for those business owners who are not fully recovered from the pandemic losses. Unfortunately, the problem of CRA tax debt can become complicated and can be full of traps. In my Canada Revenue Agency debt video, I discuss that if a tax debt is not satisfied, the Canada Revenue Agency may seize your property and sell it. In this situation, you might make a mistake of transferring the property at nil or less than the fair market value consideration to a non-arm's length party like your husband or your wife in an attempt to prevent CRA from taking your property. Please keep in mind that CRA has powers that, in such a case, it can then assess your significant other for your tax debt and it can seize this item from your significant other. Let me give you real-life recent tax court cases which are an example of how CRA appears to have increased the reach of its assessing power and also the frequency with which it applies this section. In Heaviside versus Canada, the husband transferred 50% of his property interest to his wife in 1989 for less than fair market value consideration while he had an outstanding tax debt to CRA. Well, in 1993, the husband began the bankruptcy proceedings and was discharged in 1994. The CRA assessed the wife for the husband's tax debt. In Jefferson versus the Queen, the Tax Court of Canada held that a corporation's reimbursement of a related individual's travel and entertainment expense constitutes a transfer of property for less than fair market value consideration because the individual's expenses did not relate to the corporation's business. In yet another case of Paul versus the Queen, the shareholders who owned all of the shares of the corporations were assessed for the tax debt of the corporation pursuant to Section 160 of the Income Tax Act. During the period at issue, the dividends were issued to the shareholders. The Tax Court of Canada ruled that the shareholders received dividends solely because of the right attributed to the shares so that no consideration can be said to be given by them. Therefore, accordingly, no consideration passed from either the taxpayer to the corporation in respect of the dividends paid to them. You see, the CRA justifies this type of seizure as the original tax debtor should not have made this transfer and instead use the proceeds to pay their own tax debt. If you are facing CRA tax debt, the better approach is to seek some advice from an insolvency professional and a chartered professional accountant. If an income tax return should have been filed for the year before the year of bankruptcy and was not, well, then chartered professional accountant must be used to file your income tax return for that year. If you want to be notified about my new tax updates, please consider subscribing to my YouTube channel. See you in my next video. Until then, bye.